Topic 3.5, the overnight cash market. Now, to get some context, let's go back to this slide. We are now talking in this lecture about this overnight cash market. So it's the market for one-day money. What that means is we've got institutions which will borrow money off another institution and repay that money the following day. So the loans are only for one day. Now, what I said before was that a lot of these short-term debt markets are substitutable from both the borrowers. I'll say that again. So what I said before was that these markets, the short-term debt markets, are substitutable from a borrowers and lenders perspective. So if you've got money that you have received as an institution and you have nothing to do with it for 90 days, you may want to lend it out for one period in the 90-day market, 3 consecutive periods of 30 days each in the 30-day market, or you could just keep rolling it over and loaning it to a different borrower every day in the one-day market. So these markets are still substitutable. However, the big difference between the one-day market and all of these other short-term debt markets are the range of participants in this market. So in this one-day market, it's just the big financial institutions. So let's just think of that in terms of the big banks in Australia, ANZ, Westpac, Commonwealth, National Australia Bank, etc. Obviously, it's a little bit more complicated than that, but not too much more complicated. We're just trying to keep it simple. So in this one-day market, the institutions are the big banks. However, when you get to the 30-day market, the institutions are also banks, but also in the 30-day market, you get governments, companies, etc., as well as foreign banks, foreign governments, foreign companies as potential lenders in these other markets. So from sort of 30 days onwards, you've got banks, governments, and other companies. But in the one-day market, you've just got the banks. So hopefully that's clear. So that gives you a little bit of context. So let's focus on this one-day market, the overnight cash market. The interest rate in that market is the cash rate. That is the interest rate that the central bank changes to enact changes in monetary policy. So now let's go back to the slide. Now that we kind of understand that, and this is what the overnight cash market looks like. So we've got the big players, ANZ, Commonwealth Bank, National Australia Bank, Westpac, as well as a lot of other smaller banks and other financial institutions. So while I'm saying that this market, the participants in this market are just the banks, you are going to get the odd insurance company, other sorts of financial institutions in there as well. Now, the interest rate in this market is the cash rate. That's the interest rate that everyone hears about. And obviously, there must be borrowing and lending in this market because the cash rate is the interest rate paid on that borrowing and lending. And so it must be the case that the ANZ borrows money off the CBA and maybe National Australia Bank borrows money off Westpac. We don't know why yet. I'll get to that in a little while, but they do. And this lending is for 24 hours only. The amount of money in this market is kept fairly steady at around $750 million. Now, in this overnight cash market, all of these financial institutions, to participate in this market, because it is a heavily regulated market and it's regulated by the RBA over here, to participate in this market, they need something called an exchange settlement account. So the banks need an exchange settlement account. And an ESA is a bank account held with the Reserve Bank of Australia. So just like you might have a bank account with the ANZ or Westpac, these banks also have a bank account with the Reserve Bank of Australia. And these financial institutions that operate in this market, they have to have an ESA before they can operate in this market, which means that they need to apply to the RBA to be awarded an exchange settlement account. Okay, so then the question becomes, well, why would these banks want to borrow money off each other in this particular market? Don't they have plenty of money? They're a bank, right? That's their business, to have money and be able to lend it out. Why would they need to borrow money off another bank? Okay, it works like this. Every day, The Reserve Bank keeps the amount of money in this market constant at roughly $750 million. So if money comes in, let's just imagine $100 million of money comes into this market, the Reserve Bank will take it back out. And I'll explain how that works. It works through this buying and selling of bonds here in the middle. Okay, but just for now, they keep the amount of money constant every day at $750 million by actively either injecting money into this market or removing money from this market. But I'll explain how they do that and why they do it later. So we've got 4 banks, 4 representative financial institutions, a balance of $750 million. Now, let's just imagine that on a particular day, there was only one transaction in the Australian banking system, only one transaction. Obviously, that's not going to be true. There's going to be millions, tens of millions every day. Let's just imagine there was one. And that was you paying me $100 million. You bank with the ANZ. Let's say I bank with Westpac, and you're paying me $100 million. Now, at the sort of surface level, what you and I would see is your bank account would be debited by 100 million, the balance reduced by 100 million, and my bank account would be credited with 100 million, the balance increased by 100 million. Okay, that's what we would see as customers of these banks. But behind the scenes and in this market, the money needs to be transferred between banks. So what would happen at the end of the day is the ANZ would transfer $100 million from their exchange settlement account into the exchange settlement account of Westpac, then the transaction would be complete. So obviously Westpac can't credit my account with $100 million if they don't receive 100 million from the ANZ. And this transaction, this transfer of $100 million in this market from the ESA of ANZ to the ESA of Westpac occurs at the end of the day. Okay, so how does the cash rate fit into this? Okay, let's just imagine at the beginning of this day, the ANZ had only $50 million in its exchange settlement account. You can probably see where this is going now. They've got 50 million at the end of the day, but then you pay me $100 million on this day. The problem is the ANZ doesn't have enough money to transfer to Westpac, and they can't overdraw their ESA. The Reserve Bank won't permit it. So the ANZ needs to get at least $50 million, let's say $60 million, from somewhere else. So they will announce to the market that they need $60 million. And let's just say that Commonwealth Bank puts its hand up and says to the ANZ, we'll lend you that $60 million. So now ANZ has the original $50 million plus the $60 million that they've just borrowed on the same day from the Commonwealth Bank. They've got $110 million. They can make that transfer. They've got $10 million left over after transferring the $100 million, which keeps everyone happy because the ANZ no longer is at risk of overdrawing its exchange settlement account. The next day, the ANZ will repay the $60 million to the Commonwealth. Where would that money come from? Money is always moving between banks as a result of all of these transaction flows. And if the ANZ, even the next day, if the ANZ didn't have $60 million to transfer back to Commonwealth Bank, it would just undertake another loan until the movement of money in this market sort of moved in ANZ's favour, and ANZ received sort of 70, 80, 100 million, 120 million from another bank. Now that loan of $60 million from the Commonwealth to the ANZ, obviously the ANZ will pay interest on that. It's a one-day loan, and the interest rate they pay is the cash rate. So this is a very particular type of interest rate, and that is that cash rate, the interest rate that we've just spoken about, the interest rate on that very particular loan, that is what the central bank controls in Australia to implement monetary policy. So hopefully that makes sense. By increasing the cash rate, because these markets are substitutable, any increase in the cash rate will flow through and increase the 30-day, 90-day, and 180-day interest rate almost one for one. And so by lifting the cash rate in this market, the Reserve Bank of Australia can then lift all of these other short-term interest rates out to about a year. Beyond a year, these other interest rates aren't strongly impacted by changes in the cash rate. And I'll explain why that is the case probably towards the end of topic 4. So all you need to know for now is when the cash rate goes up, it transmits and affects all of these other interest rates up to about 1 year. And as we've already seen, Australian banks borrow money to lend to their customers. Part of that money is borrowed in short-term debt markets. And so by lifting the cash rate, they can increase the cost of banks borrowing money in these short-term money markets or short-term debt markets, and those interest rates are then passed on to the customers of Australian banks. So hopefully that makes sense. That's what the cash rate is. It is, as I've got up here, is the interest rate that banks charge each other in the overnight cash market or the short-term money market. Economists use both terms. It's either the overnight cash market or the short-term money market. So it's the interest rate that is charged on interbank loans to settle interbank payment obligations. So that transfer of $1 million from ANZ to Westpac, that was an interbank payment obligation. Now, you may be looking at this thinking, well, why doesn't ANZ simply bring in money? If it's short of money and it needs another 60 million, why not just bring it in from another account? Well, they could do that, but the problem is the Reserve Bank, as soon as the ANZ brought that money in, the Reserve Bank would reverse the transaction and another $60 million would flow out to keep the overall amount of money in the market roughly 750 million. I mean, that's one point, but the ANZ could bring it. It could bring it in from another account. But the problem there is that that would prevent the Reserve Bank from lending that $60 million out to another customer. And the cash rate that it would pay the CBA will generally be lower, a lower interest rate than what the ANZ could have charged a borrower for that $60 million if it loaned it out. So there's no point in bringing money from outside the market in if you're the ANZ. It's just quicker, easier to simply borrow the money at the cash rate from another financial institution. There's no point bringing in 60 million from another account because a couple of days later, the ANZ may have sort of excess funds in their exchange settlement account and just move the $60 million back out. What's the point in that? You may as well just lend the $60 million out for a year or two and use this $750 million that always lies in this market to borrow when you need to. So there's no point bringing money in from outside, and generally the banks don't do that. Okay, the next thing, and I think the final thing we need to understand is what sort of transactions can cause money to move in or out of this market. Now, I have said it is possible for the ANZ or the Commonwealth to bring money in from outside. Okay, that is possible, but generally it doesn't happen too much. So what sort of transactions can cause money to flow, let's say, into this market? Well, it's generally transactions involving the government and a non-government entity, an individual household, or a bank or a company, some non-government entity. So let's just imagine it is pension day in Australia. And all the pensioners are receiving their pension payments from the government. The government banks with the Reserve Bank. So when all of these pension payments are made on that day, there'll be a massive amount of money flowing from the bank account of the Reserve Bank into the exchange settlement accounts of these banks. Because when pensioners get paid by the government banks with the RBA, they then need to transfer those pension payments, that amount of money, into the bank accounts of the pensioners receiving their pension payments. And the pensioners are going to be banking with all of these different banks. So on pension day, you get a large amount of money flowing into this market. The problem is the Reserve Bank is very careful to maintain stability in this market. So they don't want the amount of money in this market to explode up to 1.5 billion or 2 billion on pension day. Because what that will mean, if there's a big increase in the amount of money in this market, is the banks may start to try to lend money to each other to earn a return on the balances in their exchange settlement account. They may start to lend money to each other at an interest rate slightly less than the cash rate. And the stability of monetary policy, the credibility of the Reserve Bank relies on them having ultimate control over this cash rate. As I've said before, when the Reserve Bank says the cash rate's 3%, it's not 3.01, it's not 2.99, it's 3%. And if they allow too much money on pension day, as an example, to flow into this market, and the amount of this money in this market to go up to, say, 2 billion, it could have the effect of reducing the cash rate from its target rate of, let's say, 3% down to some lower level, and it just creates a little bit of uncertainty in the market, a little bit of instability. So when money floods into this market on pension day, or the day that tax refunds are paid, tax refunds, that is just the ATO, the government organisation who banks with the Reserve Bank, paying tax refunds to customers, that would cause a flood of money in as well. So tax refunds, pension payments, on those days, the Reserve Bank will then actually sell bonds into the market to move money back out. So let's explore that. The Reserve Bank then sells bonds. So money's come in and they're selling bonds, and they'll sell bonds to these banks. The bonds can be sold to investors anywhere in the world. So if the Reserve Bank is holding government bonds, then they could sell those bonds to anyone in the second-hand bond market anywhere in the world. So those bonds could potentially be sold to the Reserve Bank of Japan, or a hedge fund in the United States. But the Reserve Bank will always hold bonds to sell only to these institutions operating in the overnight cash market. So money is pouring in on pension day or tax refund day, and the Reserve Bank, to reverse that flow, they sell bonds to these banks. The banks take possession of these bonds and make payments for the bonds to the Reserve Bank out of their exchange settlement account. So when on pension day or tax refund day, or any other day where a lot of money is moving into this market, the Reserve Bank will be selling bonds and receiving payment for these bonds in the form of these banks paying for the bonds out of their exchange settlement account balances. So that's how the central bank offsets or reverses the inflow of money. What if money is flowing out of the market? Now, how would that happen? How would money flow out? Generally, it requires non-government entities, you, me, a company, to pay the government. So it could be a day where the government is receiving a lot of tax payments. And those tax payments from you and me will come out of the exchange settlement account of the ANZ into the RBA's bank account, and out of the ESA of Westpac and into the RBA's bank account. That will start reducing the amount of money in this market down to maybe 600 million, 500 million, 400 million. If the amount of liquidity is just money, if the amount of liquidity in this market starts to shrink, then once again, it can be very, very destabilizing for this market. And the cash rate may start rising above the target cash rate. So the Reserve Bank, this is the market through which the Reserve Bank implements monetary policy. And this market absolutely needs to be stable. Market participants need to know what is going on. So the Reserve Bank can't risk the amount of money in this market shrinking without explanation. And so as we're making tax payments to the Reserve Bank and the money is moving out of the market, the Reserve Bank will enter this market and start buying bonds off the banks. So the Reserve Bank takes possession of the bonds when they buy them from the ANZ National Australia Bank, and they make payments for those bonds when they buy them into the exchange settlement accounts of these banks. So the money, as our tax payments are money flowing out of the market, but when the Reserve Bank buys bonds, it's injecting money back into the market. And it will do so to perfectly offset, not perfectly, but very close to perfectly offset the outflow of money due to these tax payments. So by buying and selling bonds, the Reserve Bank can regulate the amount of money in this market and keep it at $750 million every day. Generally speaking, the Reserve Bank's only got to enter this market once a day to offset the either inflow or outflow of money. Because the Reserve Bank is very good at this, and so they know on any particular day of the year what the likely either inflow or outflow of money will be. So they calculate, they know what the inflow will be, they calculate they know what the outflow will be, they calculate the net figure. Some days they might know that there will be a net outflow of money of say 150 million, they'll offset that. The next day, they might know through experience and through knowing that certain transactions are going to take place. Remember, they regulate this market, so they've got oversight over this market. They know a lot about it. So the next day, they might know that money is flowing out of the market, so they'll reverse that, or it could be flowing into the market, they'll reverse that. I think the final thing to figure out is, or the final question, I've been asked this many times in recent years, is what happens if there is money flowing into this market on, say, pension payment day, and the Reserve Bank wants to reverse that by selling bonds into the market and moving some money back out. So money is coming in through pension payments. The Reserve Bank wants to take an equal amount of money back out. And they do that by selling bonds to these banks. Then the question becomes, well, they want to sell bonds to these banks to take the money out. What if these banks don't want to buy any bonds on that particular day? How do they then reverse that inflow of money? Well, that's never the case. Never happens. Because in order to create stability in this market, the Reserve Bank will offer to sell bonds to these banks. And from these banks, they'll take bids. And so the ANZ might say, we're willing to buy $5 million worth of bonds at a price of X. And so they'll take all of those bids from these banks and rank them in terms of, in order of highest to lowest. And so even if these banks don't want to buy bonds on any particular day, they'll still put a bid in, but the bid might be a very low price for these bonds. And so at some price, even if the banks don't want to buy bonds, at some price, at some low price, the banks are going to go, oh, hang on, this is just an offer too good to refuse. This bond is worth X and we're offering to buy the bond at only 95% of X. Okay, so even if they don't want to buy bonds, they'll still put in a bid, but the bid will be a very favourable price to the banks. And the Reserve Bank will come along and say, okay, we'll rank the bids from highest to lowest, and they will just start at the top and accept those bids, whatever those bids happen to be, until they have sold the amount of bonds that they need to sell to reverse the inflow of money on pension day. So it never occurs that the banks stand there in front of the Reserve Bank and say, we don't want to buy bonds. The bank, it's done another way. The banks will put in bids, and regardless of how poor those bids are, the Reserve Bank will start buying those bonds at a very, very low price and just reverse the flow that way. So hopefully that makes sense. That is the overnight cash market, and that's how it all works. What we'll do in the next slide is I'll explain to you a little bit more about, sorry, in the next video, I'll explain to you, which is actually the next slide, it's that one. I'll explain to you a little bit more about how the interest rate is set in this market. We've just been talking about a cash rate of, say, 3%, and that being the interest rate that these banks borrow and lend money from each other to and from. But it's a little bit more complicated than that. That is the cash rate setting process. So I'll leave it there. I'll leave it there for now. Finding information on the operation of this market is quite difficult. There's not too much information out there, and where I got a lot of my information from was the Reserve Bank itself. So we've had quite a number of UWA economics graduates over the years go to the Reserve Bank and work there. And actually, it was a couple of years ago, the person that controlled this market for the Reserve Bank was a UWA graduate. So he kindly spent a couple of, almost a couple of hours on the phone with me over a couple of different conversations, explaining to me in detail how this market actually works. But there's no way you can really, there's a few publications on the Reserve Bank's website, and you'll find a little bit of information here and there, but there's no single good source on how this market operates in entirety. So yeah, so there you go. That's that is how the market works. What I'll do in the next video, we'll move on to this and we'll look at the cash rate determination process, which does come from this publication down here. Yeah, and once we've gone through the next video, you should have a full understanding of the overnight cash market, what the cash rate is, how the cash rate is changed. But just one reminder, and this is super important, the cash rate is the interest rate in this one-day market. When the Reserve Bank pushes this up, it also increases all of these other short-term interest rates up to a year. When the Reserve Bank lowers this cash rate, it lowers all of these other short-term interest rates up to a year. The one-day market, 30-day market, and 90-day market are interchangeable. So substitutable, sorry. So for a bank, if a bank has $1 billion that it expects to lend out to a big customer 90 days from now, then let's just imagine it's got nothing. Then the question becomes, well, if it's lending the $1 billion out 90, let's say 91 days from now, what is it going to do with that money for the next 90 days? The answer is it could put it into any one of these short-term markets here. And so because the banks have a choice where they lend their money, and because banks and other financial institutions have a choice of where they borrow their money, when the cash rate changes, all of these other interest rates change one for one because of the substitutability of these markets. The direction of causality of interest rate changes goes from the cash rate causes changes in these other markets. If the 90-day interest rate changed for some reason, that would not cause a change in the cash rate. So these other short-term interest rates, if they change, they can't cause changes in the cash rate. It's the cash rate changing that causes changes in these other interest rates. So the direction of causality is from the cash rate to these other interest rates and these other short-term debt markets, not the other way around. I think I had a graph here. Where was it? So what we've got here, we now know what the cash rate is. The cash rate target, that's just the cash rate. So it's the red line. And we see the 90-day interest rate moving so closely with the cash rate. When the cash rate changes, it causes changes in the 90-day bank bill yield, not the other way around. Okay, so that's the overnight cash market. I'll leave it there, and the next video will be on how the cash rate is actually set.